Look around. Those gleaming glass towers, many are quietly emptying out. A silent crisis is unfolding, threatening to create a $2 trillion black hole in our economy. It's not abstract. It's affecting your city, your services, and the very ground beneath our financial system. The great office collapse isn't coming. It's already here. A glass tower in downtown San Francisco, 2024. 36 floors, built in 2003, fully leased as recently as 2019. It sold last year less than the cost of its parking structure. The building did not fail. The city did not collapse. No disaster was declared. The market simply moved, and the building was left behind. This is happening in every major American city, not loudly, without ceremony. Office towers carrying loans that will never be repaid. Vacancy rates with no historical precedent. Lenders holding assets worth a fraction of what they lent against them. An estimated $2 trillion in commercial real estate debt is set to mature by 2027. The buildings securing that debt are worth less than the loans, in many cases significantly less. This is not a forecast, it is arithmetic already in motion. A leasing office in Midtown Manhattan, 2018. The market was tight, rents were climbing, vacancy was low. Commercial real estate had been a dependable engine of institutional wealth for generations. Pension funds held it, insurance companies held it, sovereign wealth funds held it. The logic was straightforward. Businesses need space, cities grow. Long-term leases generate stable, predictable income. A 10-year lease with a Fortune 500 tenant was considered conservative, safe, backed by something tangible, something you could appraise, insure, walk through. Banks lent generously against it. Commercial mortgage-backed securities had grown into a $900 billion market. Loans bundled, sliced into tranches, sold to institutional investors across the world. The appraisals were optimistic. Occupancy assumptions were linear. Rent growth was modeled as permanent. No one modeled a simultaneous, global, permanent shift in how people used office space, because nothing in the data suggested it was possible. A real estate investment trust presentation, 2019. Every slide rested on the same foundation. Office space is a permanent requirement of modern business, not a preference, not a convenience, a structural necessity. This belief was not examined, it was infrastructural. Businesses had always needed offices for management, for collaboration, for the simple coordination of people. Lenders built it into every underwriting model. If occupancy dropped, it would recover. It always had. The 10-year lease was the physical expression of this belief, a signed contract, a credit-worthy tenant, a locked income stream. Investors priced that certainty, borrowed against it, built skylines around it. And then, in March 2020, the assumption was tested. Not gradually, all at once. And it did not hold. A corporate headquarters in San Francisco, April 2020. The offices had been empty for 3 weeks. Revenue had not collapsed. Productivity had not collapsed. The CFO was looking at two numbers: the output of the workforce, the cost of the lease. The output had not changed. The lease cost $40 million a year. This calculation was being made simultaneously at thousands of companies, across every sector, in every city. Twitter announced permanent remote work in May 2020. Facebook extended remote options indefinitely. These were not peripheral companies. They were anchor tenants, the kind that justify the construction of entire towers. By the end of 2020, office utilization in major American cities had fallen to 15% of pre-pandemic levels. Lease renewals were negotiated shorter. Some were not renewed at all. By 2023, the vacancy rate in San Francisco reached 34%. 1 in 3 offices empty. And behind every empty office was a loan. Originated in 2015, in 2017, in 2019. 10-year loans coming due. Originated when occupancy was 90%, when the assumption held. The decisions that created those loans were not reckless. They were conventional. They simply could not survive what followed. A regional bank balance sheet, 2022. The loans were still performing, technically. Tenants were still paying rent. The numbers were still green. But the leases were expiring. And behind the performing loans was a quiet question. What happens when the tenant doesn't renew? New lease signings had fallen sharply. Sublease availability had exploded. Companies still paying rent on space they no longer used were listing it for sublease, flooding the market with shadow vacancy. The official numbers did not capture this. The leading indicators did. The Federal Reserve noted vulnerabilities in commercial real estate in its 2023 Financial Stability Report. Not crisis, vulnerabilities. Silicon Valley Bank failed in March 2023 for reasons unrelated to commercial real estate. But its failure revealed something adjacent. Regional banks were fragile. A significant portion, far more than half of this debt, is held by regional banks. The concentration was documented by the Federal Reserve, by the FDIC, by academic economists who published the numbers in peer-reviewed journals. A Columbia Business School study in 2023 estimated that as many as 385 regional banks faced potential insolvency from commercial real estate alone. The study was reported, discussed briefly, then absorbed into the background. The loans were still performing. The buildings were still technically occupied. The leases were still expiring. A single loan maturity notice somewhere in 2024. The borrower could not refinance, could not sell at a price that covered the loan. They handed back the keys. The Aon Center in Los Angeles sold in 2024 for $147.8 million. It had sold in 2014 for $269 million. Not a distressed asset, a trophy building, worth 45% less than a decade prior. Blackstone stopped making payments on 1740 Broadway in New York, a $308 million loan. Not because they couldn't pay, because the math did not support it. Strategic default. When a rational actor determines that continuing to service a loan on a depreciating asset is economically irrational. It began accumulating. Not from desperate borrowers, from sophisticated institutional investors doing arithmetic. The Federal Reserve's rate hiking cycle compounded everything. By July 2023, the federal funds rate stood at 5.25%, the highest in 22 years. Office buildings are valued using cap rates. This essentially measures a property's potential return on investment. When interest rates rise, cap rates rise. When cap rates rise, valuations fall. The same building, the same tenants, the same rent, worth 30% less because the rate environment changed. Lenders began extending maturities rather than foreclose, granting forbearance, deferring recognition. Because recognizing the loss meant recognizing the loss. The technical term is extend and pretend. The building sat, the loan aged, the loss grew. A congressional hearing room, early 2024. Treasury Secretary Janet Yellen acknowledged commercial real estate as a source of stress, said it was manageable, said regulators were monitoring it closely, The word manageable carried considerable weight. It did not mean small, it meant contained. Contained assumed the losses would not propagate, that each failed loan was isolated. But banks are not isolated. They share depositors, they share counterparties, they share confidence. When depositors see losses at one regional bank, they look at their own. The modern bank run does not require a line outside a branch. It requires a smartphone and a wire transfer. Silicon Valley Bank lost $42 billion in deposits in 10 hours. New York Community Bank Corp disclosed unexpected losses tied to commercial real estate in early 2024. Analysts had expected $45 million in provisions. The bank set aside $552 million, a single quarter, an order of magnitude beyond expectation. The stock fell 50% in a single day. The realization was not a moment, it was a revision, a quiet acknowledgement that the losses were larger than the provisions, that the provisions were larger than the capital, that the capital was not sufficient for what was coming. By the time regulators used the word significant in measured, careful language, the system had already absorbed the meaning. A city budget meeting in San Francisco, 2024. Property tax revenue had been revised downward again. Commercial real estate taxes fund city services, schools, transit, public safety. San Francisco projected a $780 million budget deficit, tied in part to declining commercial valuations. The damage moved through balance sheets and arrived in cities: Chicago, Houston, Washington, D.C. Vacancy rates above 25% in corridors that had anchored municipal revenue for decades. Pension funds holding commercial mortgage-backed securities watched valuations erode. Retirees who made no decision about office vacancy rates. City employees who never heard the term cap rate compression. They simply lived inside the system. The recovery, where it came, was not shared. Trophy assets in select markets held value. Everything else declined. A 40-story tower in a secondary market, built in 1991, carrying a loan from 2016, 40% vacant. There was no recovery scenario for this building. Not because someone failed, because the world changed and the building could not. A skyline at night. Some of those lights are tenants, some are timers, set to make the building look occupied. The $2 trillion does not disappear in a single event, it erodes, loan by loan, maturity by maturity, quarter by quarter. The extend and pretend cycle delays recognition, it does not prevent it. Every deferred loss accumulates, every extended maturity narrows the options. The regional banks carrying this exposure are the primary lenders to small businesses, to the companies that employ most Americans, to communities that cannot access capital markets directly. If those banks contract, credit contracts, not visibly, quietly. Loans not made, businesses not started. The Federal Reserve can lower rates, has been expected to, but lower rates cannot fill empty offices. The demand problem is structural. Hybrid and remote work did not revert when the pandemic ended. It became practice. Companies restructured around distributed work do not reverse that restructuring because borrowing costs fall. The loss already exists. It is embedded in the system. The accounting has not caught up. When it does, the language will be calm. The quarterly disclosures will be precise. The provisions will be described as prudent. And somewhere in a city managing a budget shortfall, a family will notice the bus no longer runs on its old schedule, that the school lost a position it didn't replace. They will not connect it to a loan modification on a glass tower downtown, but the connection exists, running through tax rolls and pension allocations and balance sheets no one reads. Invisible infrastructure, still carrying weight. The timers in those towers are still running. No one has turned them off. You've just followed one decision beyond its moment. The system moved on quietly. The consequences took longer. If you value calm analysis and stories that look beneath the surface, Subscribe to Beyond the Decision, because the choice is rarely the end of the story.